Hello guys, welcome back to the Financial Academy. So this is Financial Academy. In today's video episode, I'm going to be teaching you everything you need to know from the candlestick, because this video is the part 2 of my series. Are you getting my point? So this video is the part 2 of my series. I've already posted the part 1 on YouTube. So if you haven't watched the part 1 of the video, check out the video in my channel and look out for the video that I write part 1. Then watch that video, then you come back to this part 2 and start from here, so that you won't miss out in the part of the video, because I've already done the first part. Now this is the second part. So make sure to watch this video from the beginning to the end. So if you're seeing me for the first time, all I create is about forex trading, stock trading, crypto trading, and real estate investment business. So if this thing is what you like, make sure to like this video, make sure to subscribe to my YouTube channel, and also make sure you comment down below. Ask me a question concerning everything and everything concerning the forex market, concerning the stock market, concerning the crypto market, and concerning the real estate investment market. This channel is for you. So please make sure to subscribe to my YouTube channel, and also make sure to share this video to your friends and loved ones. Understand? So I will begin from where I stop, which is the part 2. Understand? So this is the part 2 of my video, where I will be breaking down for you everything from candlestick to the risk management and trading psychology and the rest. So follow me right now. Let me head over to my screen. When I head over to my screen, then I will break everything down for you. So let's go to my screen right now. Let's go. Hello guys, welcome back to the part 2 of my series on forex trading. Understand? Welcome back to the part 2 of my series. So you are welcome to my screen. Let's continue from part 2 from where we stop, which is the candlestick. So if you haven't yet watched the part 1 of my series, go back to my YouTube channel and check out my part 1, so that you will understand the beginning before you join this one. Or else you are free to watch this one. After watching this one, then you go back to the part 1, so that you will understand everything. You understand? So let's continue. Candlestick. Candlestick was invented by Huma Munshia, who is widely known as the father of candlestick chart pattern. The success of technical traders is hinged on the ability to appropriately interpret Japanese candlestick pattern. Understand? So candlestick was created by a Japanese trader. Understand? So that is why it is called Japanese candlestick. So was created by a Japanese trader in far away more than 100 years ago. So, and candlestick is what we will be using to analyze the market, because we have other types of charts, but candlestick chart is the best, and candlestick helps you to easily understand the movement of the market. I have gotten my point right now. So if you can see the diagram, you can see the diagram of the green candle and the red candle, meaning the green candle is bullish and the red candle is bearish. Understand? So let's continue. Candlestick are long bar with shape that respond to ups and down movement in the market. Understand? So a technical trader can look at his chart and use the shape of candlestick that form at any particular point in time to tell a story about price movement at a time. This is because Japanese candlestick are the language of financial market. If it can be mastered, then chart interpretation becomes much easier. So in these places, what is you need to understand is this: if you can be able to master Japanese candlestick, my brother, you have already solved 50% of your problem in forex trading. Understand? So if you can be able to read and understand and interpret the formation of each Japanese candlestick whenever you see them in your chart, then you have already solved the problem you are going to face in your trading by 50%. Are you getting my point right now? Then let's continue. The anatomy of candlestick. So you need to understand the anatomy of candlestick, how the candlestick works, how the candlestick operates. Understand? So a Japanese candlestick consists of open, high, low, and close, and the choosing period of the candlestick represents. Understand? So it means that every candlestick that you've seen, it have a high, the opening it has the closing, it has the high, and it has the low. Understand? The open means at the price at which the candlestick opened. The high means the highest price at which the candlestick was able to attain, and the low means the lowest price at which the candlestick was attained, and the close is the closing price at which that particular candlestick closed at. Understand? So in candlestick we have the bullish candlestick and we have the bearish candlestick. Are you getting my point right now? So in bullish candlestick, the first thing that happens is, as you can see in the diagram below, the first candlestick open below, then move to the high before it forms a wick, and then closes at this point. Understand? So in this period, you can see that the bullish are in control. So as the bearish candle, you can see that the bearish candle open at the beginning at the top, then moves to the high before it drops a wick, then comes down low, and then closes, then prints the wick. So it means that the bearish, that sellers are in control. Are you getting my point right now? So if you watch this diagram, you can be able to know the bullish, how it open and how it close. So the bullish opens at the bottom and closes at the top, while the bearish open at the top and closes at the bottom. Are you getting my point right now? So let's continue. Whenever the close of a candle is above the open, then the candle is said to close bullish on the time frame under consideration. In other words, if the close is below the open, then the candlestick is bearish on the time frame. Note that a candle might close bearish on a smaller time frame and remain bullish on a higher time frame. These and many more we are expected to understand while trading the Japanese candlestick. Understand? So you need to know that a candlestick might closes a bearish on a small time frame and remains bullish on a higher time frame. Understand? So this is why and this is what you are going to expect, and that is why you need to understand the candlestick chart pattern very, very well before diving in to trade the forex market. As someone who is beginning to trade, someone who is starting out to trade the forex market as a beginner. Are you getting my point right now? So let's continue. Importance of candlestick. Candlestick are important as we have said earlier, because it is the visual representation of price movement in the market. Most traders use only candlestick chart pattern to trade, and because of their mastery of it over time, they are successful. But most traders use it together with technical analysis to create a confluence before executing. You understand? So most traders have used candlestick chart pattern and they are successful in using it, while others make use of the combination of the candlestick and technicals together with confluence in order to get the result before they enter their buy or sell trade. Are you getting my point right now? Let's continue. What is a shadow? A shadow is sometimes called wick. It is simply a retracement of price back to the previous level. This is a consequence of further change in demand and supply mixed in market. For instance, in a bullish market where the buyers are in control, supply may be more than a certain price level, thereby making price drop drastically low. The retracement leaves a long tiny rope like shape on top of the bar called shadow or wick. Understand? So candlestick shadow is more like a wick. As you can see the diagram, this is the buying pressure. For example, the candlestick open at this level, understand, but it went down low to this level and then end up closing at this level, understand, but this is the highest point at which the price attained. Then the footprint it left is what we call, as you can see the arrow in this green it's called the wick. It's the wick because the candlestick did not actually finish this low. It finally went back. That is called the wick. the source as the selling pressure. The candlestick opened at here and then went to this very high, but it could not sustain the high. Then it later went low and were able to close at this very level. It is called the selling pressure. So because in this market of forex trading, we are fighting with the market, with the buyers and sellers. Understand? Sellers and buyers are fighting. So as this one is more of a static market, because you do not know whether the market is buying and we don't know whether the market is selling. So but even at that, it still drop a footprint of wicks, showing that the winner did not win, rather than showing that the seller did not win, rather the buyer win. So it is more of a static market. Understand? And this type of the market, you're not meant to trade this type of market, because when the market is static, you do not know whether the market is going up or going down. So you have to wait for the next candlestick to form to give you direction on where the market is likely to go. Are you getting my point right now? Let's continue. It gives us a vital information about price movement at that point in time. If the shadow is short, it means that most of the trading was confined around the open and the close. Are you getting my point right now? So let's talk about the doji candlestick pattern. Are you getting my point? A doji candlestick is a pattern that shows equality in the opening and closing price in the market. The buyers are not in control, neither the sellers. In summary, we can say there is indecision in the market. So a doji candlestick is a more of a stagnant market. It's a more of a market that is standstill. You don't know whether the candlestick is moving upward or whether the candlestick is moving downward. As you can see, this is the diagram of a doji candle. Yes, of course. As you can see for the diagram above, the opening price is the same as the closing price. Are you saying it? The opening price is the same as the closing price. So as this thing. So whenever you see this type of candle in your chart, you know that this candle is a doji candle. Understand? So how do you now trade this candle? Whenever you see this candle in your chart, what it means is that there is an indecision in the market, that the market have not yet confirmed whether the buyers are in control or whether the sellers are in control. So in this type of market, you need to step out of the market and wait for the market to give you the footprint. Then you follow the market. Are you getting my point? So what it means is this: when you see this in the market, it simply means that the trend is coming to an end and a reversal is imminent. The higher the time frame, the more valid a doji is. Understand? So the higher the time frame, the more valid a doji is. As you can see in this chart, you can see a doji here. You can see doji candles. If you can look at it, you can see doji candle. You know that there is indecision in some of this area. You don't know whether the market is, you don't know whether the sellers are in control or the buyers are in control. But the more you see this doji candle on a higher time frame, the more it gives you more strong signal for you to know that change is imminent in the market. Are you getting my point right now? As you can see, this arrow, this red arrow at the bottom, where the doji candle appear. Then after it appear, then the market begin to move towards the upside and the market started buying. So know that how the market turn about the formation of a doji at the low of the market structure. So if you can know this very well, you can see how the market turn around. Are you getting my point? So this is how the doji candle forms. This is when they are indecision in the market. After that, once you see the blue candle, then you can now join the buyers and start buying from there. Are you getting my point right now? So let's continue from where we stop. Dragonfly doji. This is a bullish candlestick pattern in which the open high and the close high are the same. Understand? This illustrates a clear dominance of buyer over sellers in the market. Are you getting my points? So if you see a dragonfly doji, you see where open and closing are almost at the same. Are you getting my point right now? But look at it's formed a very strong footprint of a wick and they had low, and you can see that there is a clear dominance of buyers over the sellers in this market. So you are looking for opportunity for opportunity to buy in this type of
opportunity when you see this type of candlestick form, most especially in the higher time frame. Are you getting my point right now? Let's continue. If the buyers want to push the price higher, it is characterized by a long wick and a tiny bar up, where the opening price and the closing price on that candle are almost inseparable. Understand? So we have the gravestone doji. It is the bearish form of dragonfly doji. It shows sellers' dominance over buyers. This results in decrease in price. It is characterized by upper tail and very close high and close price. Appearance of this pattern at resistance is an indication of trend reversal in the opposite direction. Are you getting my point? If you can see the diagram below, this is the gravestone doji. You can see this is the opposite of dragonfly doji. Then the bearish open, the open and close are almost the same thing, but now it is opposite of dragonfly, which is now the sellers are in control over the buyers. Are you getting my point? So when you see this kind of candlestick pattern, most especially on a higher time frame, it means that there is a likelihood of sellers trying to push the market downward. Are you getting my point right now? So let's continue. We have the morning star. The morning star, this is a bullish reversal pattern that's formed at the support zone in a downtrend, and it consists of 3 candles that combine to form the pattern. So morning star candle is a bullish reversal pattern, and it always forms in 3 candles: the bearish, the little bullish, and the big bullish. Understand? So it always form 3 candles. So once you see this type of candle, you know that this type of candle is a morning star, and that is a likely bullish reversal pattern, and there is a likely bullish reversal in the market, that the buyers is about to buy the market whenever you see this kind of candlestick on your chart, most especially on the higher time frame. Understand? Not that you will see this thing on the lower time frame. You will see it on the lower time frame, just that there is more of fake breakout or fake formation in the lower time frame, because the lower time frame moves very fast, but the higher time frame takes fast to pick and gather information before it prints those candlestick, and higher time frame have more strong signal than the lower time frame. Are you getting my point right now? You will see it on the lower time frame, just that the signal might be very, very low to compare the higher time frame. That is why I always tell you to see it more, and the signal is more strong on the higher time frame. So let's continue. A bearish candle followed by a smaller bullish or bearish candle that close below the close of the bearish candle, and a bullish candle that fully engulf the other 2 candles. This pattern exactly captures how buyers took control of the market when it appears at the support. It is considered as a powerful price reversal pattern. I got my point right now, which I have already explained earlier on. This is considered as a very strong reversal chart pattern. Are you getting my point right now? If you can see the diagram, exactly where this candle actually form. You can see that I circle it pink. You can see where this morning star form. When it formed, the market, there was a very huge reversal. The market moved upward very high, as you can see very well in this my diagram. So let's continue. The chart above captured the price reversal at the formation of the morning star, and at the bottom of the chart is a bearish trend. Are you getting my point now? Whenever the middle tiny candle appear in the form of doji, it shows that there is a clear indecision between the buyers and seller. But confirmation comes at the completion of the pattern with the bullish candle. So open a long position upon confirmation. Are you getting my point now? So when you see this type of candlestick, what you need to do is to do what? Open a long position upon the confirmation. Let's continue from where we stop. We have the evening star pattern. The evening star is a bearish reversal pattern, usually found at the top of the chart, that is resistance. It is a pattern that suggests that buyers are overwhelmed by sellers and the price is pushed down. Are you getting my point right now? This is the evening star. So see the evening star as the opposite of morning star. Are you getting my point? So see the evening star as the opposite of morning star. So it is characterized by a fully formed bullish candle, followed by a small candle, and then a fully formed bearish candle. If you can see the diagram below, you can see how the evening star form. So then when it formed finally, it then crashed down toward the stand side. So it is formed first of all the bullish candle. After you form the bullish candle, then it forms a big huge bearish candle before the market started moving drastically down towards the sell opposite. As you can see how it appears on this chart. Are you getting my point right now? So open a short position upon the confirmation. So it means that whenever you see this kind of candlestick pattern, open a short position, most especially if the signal is strong on a higher time frame. Understand? That is why you need to have a confluence that confirms your entry before entering a trade in the market. Are you getting my point right now? Then we have the hammer. The hammer, the hammer is formed when the opening and the closing price are almost the same, with a long wick or tail at the bottom of the head. It resembles a hammer in shape. If you can see this hammer, it resembles like a hammer, like a normal hammer that we are using, that the carpenters are using. If you can see it now, it resembles a hammer in shape. If you can see this diagram very well, and you can see that this thing is resemble a hammer, so you call it a hammer candlestick. Understand? So this is how it looks whenever you see it on your chart. Are you getting my point right now? So this is another reversal candlestick, especially when it's formed at the support of a downtrend market. So it's another reversal candlestick pattern, especially when it forms in reversal of a downtrend. As you can see, when it forms in the reversal of a downtrend, then the market started trading upward. So this is another candlestick sharp pattern that you need to know and understand in the market. Are you getting my point right now? So let's continue from where we stop. So it shows clearly the appearance of more buyers that overwhelm the buyers at the demand zone in a downtrending market. So in this type of candlestick pattern, enter a long position upon confirmation. So let's continue. We have the shooting star. So the shooting star candlestick pattern is the opposite of the hammer. Are you getting my point? The shooting star candlestick pattern is the opposite of the hammer. So shooting star is a bearish reversal candle that is usually seen at the resistance of an uptrend. So this is a shooting star candlestick. So it is normally seen at the resistance of an uptrend. Are you getting my point right now? Do you see it? So this is the shooting star. So make sure you are seeing this diagram very well, so that whenever you see them on your chart, you can be able to depict and see it very well, so that it won't confuse you. So it gives you a lot of clue as the trend reversal. I love to see this candlestick from a higher time frame, like 4 hours, daily chart or weekly chart. So that is why I tell you I love to see this candlestick chart on a higher time frame. Understand? The moment I see them on a higher time frame, it gives me on confirmation that true this candlestick is very likely to reverse. So when the candles form at the resistance of a near resistance or near resistance, it should be taken as a high probability trade setup, which marks the end of an uptrend. Are you getting my point right now? So when you can see this chart, and you can know that this is when it forms at the end, at the top, at the or high upward before it reverse down to the downside. So that is what the shooting star candlestick pattern is all about. Are you getting my point right now? So upon the confirmation of shooting star, traders enter in a short position, most especially if you see this confirmation in a higher time frame. It is very easy to identify this pattern, and I have used it in several spots in high probability trade. So it is very easy to identify this pattern, and this pattern I have already used it in my trading. You understand? So you need to identify this pattern very well, so that you can be able to use it in your trading. Because what I'm teaching you is this: after watching this video and after learning everything, you need to go back to your chart, to your trade, to able to depict all of them one after the other. Are you getting my point right now? So you have the tweezer top and bottom. So the tweezer top is a bearish reversal pattern seen at the top or resistance of an uptrend market. It is characterized by two candles. Are you getting my point? So you can see the diagram below. The tweezer tops. This is how it looks in the chart. The first candle is bullish. That gives you an impression that the price is still going upward, but followed by a bearish candle that immediately signals the presence of sellers in a great number than the buyers. So this action pushes down the price lower. Open a short position upon the confirmation. So whenever you see this type of candlestick, the tweezer top in your chart, know that they are potential of the sellers coming in the market, most especially if you see it on a higher time frame. Are you getting my point? So as you can see it on this chart, this is how it forms on a higher time frame. It is called the tweezer top. It is called the tweezer top candlestick chart pattern. So you also have the tweezer bottom, which is the opposite of the tweezer top. It occurs at the bottom of a downtrend market, and it consists of two candles. Are you getting my point right now? So look at the tweezer bottom, and this is how it looks whenever you see them on your chart. Are you getting my point? Look at this diagram very well, and you can be able to dictate the tweezer bottom whenever you see them on your chart, mostly on the higher time frame, because the higher time frame gives you more accurate signal than the lower time frame. That is why I always tell you to check it and confirm it more on the higher time frame, so that it will give you strong, more accurate signals than the lower time frame. Are you getting my point right now? Let's continue. If the first is a bearish candle that shows that price is tending south, but immediately resisted in a equal or greater measure by buyers who pushes up the price, open a long position upon confirmation. Are you getting my point right now? Tweezer bottom. This is the example of tweezer bottom, as you can see it. Are you getting my point right now? Then the harema pattern, which is the insider bar. Harema is in Japanese means pregnant. It consists of two candlesticks. It's considered as a reversal and a continuation pattern. Are you getting my point? So this is the diagram of the harema pattern, as you can see it. So this pattern indicates a decrease in momentum, and it occurs when a line with a small body falls within the area of a large body. So it's normally called the pregnant candlestick pattern. Are you getting my point? But the most important thing is for you to be able to detect what this thing is used for, not just the name. Are you getting my point right now? So the first large candle is called the mother candle, and the second candle is that must close inside the mother candle. Fire is inside the mother candle. Inside the mother candle, fire the setup to be considered harema. So if it occurs at the resistance, then it is a bullish reversal. But if it is clearly seen at support, it is a bullish candlestick reversal. Are you getting my point right now? So if you can look at the diagram very well of how I circle it, which is the bullish harema pattern and the confirmation reversal candle, then you can be able to see it for yourself and be able to know whenever you see them on your chart and how they form in your chart. Are you getting my point right now? So look at this diagram very well before you can be able to dictate it, so that you don't make any mistake when detecting this candlestick. Are you getting my point right now? So let's continue from where we stop. Classic technical sharp pattern. So in this section, I'm going to be telling you the classical technical sharp pattern. So let's continue. One of the ways to make trading fun is a clear understanding of sharp pattern. Are you getting my point? There are many traders who will not master anything else other than sharp pattern, which have proven to be a successful trading system. Are you getting my point right now? So sharp pattern have proven to be a successful trading system in the market. So on the sharp pattern, we have so many sharp pattern. We have the double top, we have the head and shoulder, we have the rising wedge, we have the double bottom, we have the inverse head and shoulder, and we have the falling wedge. You understand? So the double top, is a reversal pattern that can be spotted on resistance of uptrend market. If you are trading from 1 hour or 4-hour time frame, you can look for double top on 15 minutes or 30-minute chart. So you can also find double top on a higher time frame like daily or weekly. The higher the time frame from which double top is spotted, the more powerful it has usually proven to be. The good thing about double top is that you can predict the reversal or the continuation almost the exact pips when there are not too many fluctuations in the market. Are you getting my point? So you can be able to depict the double top candles, the double top sharp pattern more on a high time frame, and it will give you more clear signals, and it will give you more confidence for you to enter that particular trade. Are you getting my point right now? Then we have the diagram below. If you can see the diagram below, this is an example of double top. If you can see it clearly, this is an example of double top pattern. So you can be able to depict it whenever you see them on your chart. Are you getting my point right now? So take a look at this diagram very well. Then look it very well, so that you can be able to know how to detect and depict a double top pattern, a double top sharp pattern on your trading chart whenever you see them in the market. So let's continue. We have the double bottom. Double top bottom. Like me personally, I always prefer to trade reversal from downtrend to uptrend whenever the double bottom is formed from lower time frame. The pattern is like double top. It's very easy to find because what you are looking is for a support zone that has been hit before, and it has been tested again to form double bottom. It happens a lot in a downtrend which signals reversal, and it can also be spotted inside of the uptrend, which adds more validity to the trade setup. Are you getting my point? So mainly you can see this type of sharp pattern on a downtrend. Are you getting my point? You can see this sharp pattern on a downtrend. If you can see this sharp pattern, look at it very well. You can see it on a downtrend. So when you see it on a downtrend, you can be able to depict and detect how it forms. When the market was moving at the downtrend, it formed the first button, then move to the neckline, then form the second button, then break out of the neckline. Then for a trader, how you enter this trade is that you'll be waiting for it to break out of the neckline. Once you break out, then you enter your trade. Are you getting my point right now? So that is it. Then we have head and shoulder. Head and shoulder. This pattern is so named because it forms one head and two shoulder. One of the best ways I personally have traded several is spotting the head and shoulder pattern, and it can be easily spotted in the uptrend. So you'll be asking yourself, how should you trade head and shoulder? So for most aggressive traders likely who like to enter from the top, that is the head, but I always advise that you should be patient to allow the neck to be broken. Find a retest before the entry for a short position. So the danger of making aggressive entry from the top, which is the head, is that there may be continuation of the uptrend and stop loss could be hit if you like to see the right shoulder complete at around 50% Fibonacci retracement. So more likely, if you want to trade this head and shoulder pattern, you need to wait for it to break the neck, for it to break the shoulder before you can be able to trade it well, so that you won't stop out, or so that you won't stop out prematurely, or your trade being hit stop loss because of aggressive entry. Understand? Because some traders are aggressive whenever they are entering the market. Are you getting my point right now? So you don't need to be aggressive as a trader. You need to be conservative sometimes whenever you are trading, and you need to be very careful when you are trading the head and shoulder pattern. Are you getting my point right now? So as you can see in the diagram, this is the head and shoulder. As you can see, this is the shoulder, this is the head, and this is the shoulder. Then this is the break of the neckline. Are you getting my point? Before the market start dropping. Are you seeing it now in this diagram? Then let's continue from where we stop. Let's continue from the inverse head and shoulder. This forms an opposite pattern to head and shoulder. You can spot this in a downtrend which signals a reversal. You can trade it with confidence when you allow the neck of the shoulder to be broken before looking for long entry position. Are you getting my point right now? So if you can see this diagram, you see how the inverse head and shoulder form. From the downtrend, it forms the neckline, it goes down, it forms the head, and push ups again, it forms the neckline, second neckline, and comes down, it forms the second shoulder, then before it break out. So upon the breakout, you wait for a retest or a pullback before you can enter trade long. Are you getting my point now? So that you can be in a safe side, so that the market won't stop you out prematurely. Are you getting my point right now? So we have the rising wedge. The rising wedge can be either a reversal or continuation pattern. It is formed after an uptrend leading to reversal. Sometimes it could also break out to the upside for continuation of uptrend, but most often it break out to the downside. So this is the rising wedge. As you are seeing the rising wedge, the line that is being drawn, this is called the rising wedge. And the rising wedge pattern, you can see where you need to put the stop loss. Then when the market break out, you need to put the entry price. You need to enter at this price level. When you enter the price level, you need to allow the trade to move. When you allow the trade to move, then you can see how much profit you have already made. Most especially if you trade this thing on a higher time frame. This thing on a higher time frame is more than 300 to 400 pips. Are you getting my point right now? So you need to watch this diagram very, very well in order to understand and dictate high rising wedge, higher rising wedge pattern whenever you see them on your chart. Are you getting my point right now? So let's continue. We have falling wedge. Falling wedge look at the wooden edge downside. It is more of a reversal than continuation pattern spotted in an uptrend. So it usually break out of upside for continuation. Most classic pullback you spot in forex chart forms a falling wedge pattern that when there is a breakout, then there is a continuation of an uptrend. So as you can see the diagram, this is the diagram of falling wedge. So when the market is moving towards the downside, that is when mostly the falling wedge forms. Are you getting my point right now? Let's continue. We continue at the harmonic pattern. Harmonic pattern are used to set targets, price, stop loss limit, stop losses, and limit orders. So it is an application of set of Fibonacci sequence. I find this pattern useful because they are sometimes precise in their accuracy and work best for proper position sizing. So this is the extension that serves as the entry point price, which usually range or value within the Fibonacci sequence. Entries are therefore based on objective approach, based on mathematical formula that takes it through from Fibonacci sequence. We make use of Fibonacci retracement and extension. The most important Fibonacci retracement level are 0.38, 0.5, 0.50, 0.61, 0.78, and 0.8 and 0.80. Are you getting my point? Then the most important extension on the Fibonacci extension sequence is 1.27, 1.61, 2.0, and 2.61. Are you getting my point? So now let us start examining this pattern and how we can apply them in our trading. Let's begin to examine. You don't need to compulsively memorize the ratio of Fibonacci retracement and extension for each pattern. Instead, make use of the sheet chart to get the ratio, and from there know the name of the pattern that is formed. When trading harmonic pattern, you should get in the trade at the point D, just as shown in the diagram below. So when you are trading this harmonic pattern, just take a look at your Fibonacci retracement. Just take a look at this retracement extension from the X, A, B, C, D. Then look at the harmony in the D. When you can see the retracement at the D, then you can begin to buy, as you can see in the diagram below. So below the chart, the sheet chart containing the ratio of retracement and the extension for the major pattern, for the entire major pattern. Are you getting my point right now? So we have the bullish shank pattern, we have the bullish shank pattern, and we have the bearish shank pattern. So this is the opposite of this. So the bullish shank pattern, as you can see, when the market moves up, it moves down, it moves down, then it moves down before trying to move to the upside again. So as the bearish, when the market moves down, it moves up, it moves down, it moves up, then forms a signal at the C before crashing down to the downside again. Are you getting my point right now? So let's continue with the bearish greatly. So the opposite of bearish greatly is the opposite of bearish greatly. We have the bearish bat. So as you can see how it formed from X to A to B to C, then to D. Wait for the candlestick formation to form, then you sell from there. The same thing as bearish bat, as it move from X to A to B to C to D, wait it in D for it to sell the market. So whenever you are trading this kind of harmonic pattern, wait using the Fibonacci extension, wait for it in the D before you can sell it the market. Are you getting my point right now? So then we have bearish butterfly, then and we have the bearish crab. So as the same pattern that I've already told you, from X to A to B to C to D, then you short the market. Even if it is a bearish crab, then you look at the X to A to B to C to D, then you sell out the market. Are you getting my point right now? So you take your time and look at this diagram. You can be able to understand that and pick it. Look it for where your chart with. Try to test it out with your Fibonacci extension. You will find out what I'm telling you is very, very, very accurate. Are you getting my point right now? Let's continue. Then you'll be talking about types of traders. Are you getting my point right now? So we'll be talking about types of traders. We have scalpers, because scalper traders jumps on each trade, because so many people don't know that there are different types of traders in the market. So we have different types of traders. So number one is scalpers. What exactly are scalpers, or who exactly are scalpers? Scalpers traders jump on each trade only to catch small gain on each trade. These type of traders are often not interested in the big move the market has to make. All they do is to monitor the chart, have multiple trade entries, and exit quickly once in profit. This best suits those who can spend several hours on the chart daily without distraction. So this set of traders get into the market and exit based on predefined rules. Most time with the use of some oscillating indicators. Understand? We have day traders. Day traders will enter and exit their trade within the same day. So they are neither scalpers nor swing traders. So day trading also involves a lot of time in analysis, executing, and monitoring. These traders like staying with a bias of the market and then react in the line with their bias till the day is over. It is also very important to keep up any high impact news, and maybe stay out of the market to protect profits when such news is being released. So day traders are basically people who trade from day to day. They open their position in the same day and close out of their position in the same day. You understand? So we have swing traders. Swing traders, this is trading style that best suits for those who have full-time job or school. Are you getting my point? So swing trading requires one to hold trade for days with a lot of patience. Are you getting my point? Buy from a swing low and sell at a swing high, always placing the higher time frame trend into consideration. So the swing trader always trade using the higher time frame. They make the analysis on the higher time frame, and also they enter their trade on a higher time frame, because they are holding their trade more than a day. Understand? So let's continue. As you can see, this is the example of swing trading of the Euro USD on a daily time frame. As you can see, the market moves from swing low to swing high swing low to swing high to swing low to swing high. So as a swing trader, you can be able to buy from here to here, sell from here to here, then buy again from here, then from here to here, buy again, hold it up to here, then sell again and buy again up to this swing high. Are you getting my point? So what swing traders do is that they are riding the market swings. When they are riding the market swing, they will be breaking even their profit and closing out of their position. Are you getting my point? So let's continue. Since it attracts huge profit, a swing trader will also apply huge stop loss in order to give a room so that market frustration will stop it out prematurely. Are you getting my point right now? So we have position traders. This is the longest term. This is the longest term trading. It involves holding trade for several months in a year. Are you getting my point right now? Position traders are mainly traded by those people who are big banks, hedge fund, the likes of JP Morgan, the likes of HSBC, the likes of Bank of America. These are more of the investors who trade the currencies on a long term. Are you getting my point right now? So position traders, it is the longest term of trading. It involves holding trade for several months to a year. A very good understanding of fundamental is highly required. So you need to understand and master fundamental analysis. Position traders should understand how economic data affect the currency's economy. Position trading also requires the ability to ignore popular opinion, because a single position trade will often hold through both bulls and bear markets. For example, a long position trade may need to be held in an entire year when the general public is convinced that the economy is in recession. If you are easily swayed by other people, then the position trading is going to be difficult for you. I got my point. Note, you have to determine you have to determine the type of trader that you are. No matter what style you choose or have a mind to choose, make sure that it fits your personality. So do not become a scalper because a famous successful trader is a scalper. No. Become a scalper because you want to become a scalper because it suits your personality. Are you getting my point right now? So that you won't be burnt out on the wrong run. Know yourself and stick to the style that fits your style. Are you getting my point? So I will continue from creating a trading plan, which is the next thing that I'll be talking about. So in the next slide, I'll be telling you how to create a trading plan. So let's continue from where we stop. Hello guys, welcome back once again. So let's continue from where we stop, which is creating a trading plan or creating a trading system. Two of them are still the same thing. Are you getting my point? So trading system is a fixed process, systematic approach used to enter in a trade and closing out in a trade. So it is highly fundamental to your trading career, making you sure you create a trading system. You need to understand the basics and how it came about, stick with it and master it. So you must have the phrase a lot. No strategy is a hurry grail. No, there's nothing like perfect strategy in the market. This is true, but creating your own trading system gives you edge over others because you should know why it works and the market condition, where it should work best. There are times you have losing streaks. Stay, but put and trust the process. Every trading system does experience weeks or months of losing streaks. The idea is to trust the process during these ups and downs. Are you getting my point? So what I'm about to say is that as a trader, you need to have a trading system. Are you getting my point right now? As a trader, you need to have a trading system. You need to have a trading plan, because it is more like in a business, if you don't have a plan for your business, that means definitely that business is bound to fail. So you need to have a systematic approach to your trading. You need to have a plan to your trading so that it will help you being a successful trader at the long run. Are you getting my point right now? So let me give you 10 steps to forming your first trading strategy. Understand? So you need to follow these 10 steps to follow your trading strategy. Number one step is form your market ideology. Are you getting my point? Number one is form your market ideology, because right now I want to give you the 10 steps to forming your first trading strategy. Are you getting my point right now? Number one is form your market ideology. Before you step into creating your own trading strategy, you must develop an idea of how the market works. Most importantly, you need to answer this question: why do you think you can make money from the market? Are you getting my point? Form your market ideology by reading wisely. Read about technical and fundamental analysis. Are you getting my point now? Also, avoid get rich quick schemes claim. Yes, of course. Please avoid get rich quick claim. It is very, very important. One of the things that killed beginner traders is having this get rich quick scheme mentality. This kind of thing doesn't exist in the forex market. Yes, forex market will make you wealthy, but it is not a get rich quick scheme. Are you getting my point right now? Let's continue. Think about demand and supply. Then doubt theories that claim that people are perfectly rational. Your ideology will define every step that every step follows. Understand? Give it attention and give it deserve. So when you are creating this your plan, give it very attention it deserves, so that you will get the best out of your trading plan. Regardless, I urge you to follow one principle in your first trading strategy. Understand? So keep it as simple as possible. So keep your trading plan as simple as possible. So you don't want to be overwhelmed by a complex strategy right from the start. Moreover, a trading strategy with more moving parts is hard to manage and improve. So you need to have a single strategy that you have already built, master, refined over the time. Are you getting my point right now? Number two, choose a market for your trading strategy. You can choose whether you want to trade the forex market. You can choose whether you want to trade the equities. You can choose whether you want to trade the option, or you can choose whether you want to trade the futures. So if you choose to trade forex, understand why you are buying and selling with the currency quotes. Make sure you learn about different model of forex brokers. Know how the margin is calculated. Or if you choose to trade equities, you must know what a share means. You must know the difference between a blue chip and a penny stock. The point is this: there is a lot to learn about each market, but you cannot start to learn in depth until you choose your trading market. Are you getting my point? Although I recommend futures trading for intraday traders. The choice is yours. The only rule is that you must understand the market you choose to trade, so that you can apply it in your trading plan. Are you getting my point right now? Number three, choose a trading time frame. Yes, of course. My brother, please, as a beginner trader, don't jump from one trading time frame to another trading time frame. No. Choose a specific trading time frame. Before you gain any trading experience, it is hard to decide on a trading time frame. You will not know if you are suitable to quick scalping or daily swing trading. You should trade in the 5 minutes time. Should you trade in the 5 minutes time frame or daily chart? Hence, you can start by considering your circumstances. If you have time to watch the market for a extended period, try intraday trading. When you trade fast time frame, you get fast feedback to shorten your learning time. Even if you end up with longer time frame, what you learn from intraday price action will still be useful. Are you getting my point? So, and of course, if you are not able to watch the market for extended period, start with end of the day chart. With sustained effort, you can learn enough to decide if swing trading is for you. Are you getting my point right now? So it is now everything now boils down on your court. You can choose whether you want to trading a swing trading, whether you want to be a scalper, or whether you want to be an intraday trader. Everything is up to you. Everything is up to your personality. I am not the one that will choose it for you. Are you getting my point right now? So choose your trading time frame wisely. Number 4, choose a tool to determine the trend or lack of it. So you don't trade when you see a pin bar. No, you trade when the market is rising and you use a bullish pin bar to trigger your trade. You don't trade when you see a jamming bar. No, you trade when you judge that the market is going sideways and you use a jamming bar to enter the market. Decide on the tool to help you judge the market contents, whether it is a trending not or the upward or downward market. Are you getting my point? You can choose price action tool like swing pivot or trend line. You can also use technical indicator like moving average and MACD. Are you getting my point right now? Number 5, define your entry trigger. Even with the right market context, you need an objective entry trigger. It will help you to enter the market without hesitation. Both bars and candlestick pattern are useful trigger. If you prefer indicator, oscillator like the RSI and stochastic are also good option too. Then you have the stochastic for swing trading. If you're a swing trader, then using a stochastic indicator is also good for you. Number 6, plan your exit trigger. You need to plan how to exit when things go wrong in the market. The market can go against you, causing you loss beyond your imagination. Having a stop loss is very, very critical. As someone who is starting out trading, having a stop loss and exit plan is very, very, very important. So you need a plan on how to exit when things go your way. The market will not go the market will not go your way forever. Hence, you need to know when to take profit. Are you getting my point right now? So you need to know when to take your profit and get out of the market to avoid market swallow your profit. Number 7, define your risk. Once you have your entry and exit rule sorted out, you can work on your limiting risk. The primary way to do is by position sizing. For a given trading setup, your position sizing determines how much money you are putting in on the line. Are you getting my point? Double your position size and you will double your risk. Watch out your position sizing carefully. So know the amount of position. So know the amount of lot size that you are putting in on your trade. Because the higher your lot size, the higher your risk, and the lower your lot size, the lower your risk. Are you getting my point right now? Number 8, write down your trading rules. At this stage, your trading strategy is simple. You might be able to memorize the trading rules. However, you must still write it down, your trading rules. So that you need to write it down so that you will be seeing it, whether it is in your wall or in your room, anywhere, but you need to write it down. Having a written trading plan is a robust method to ensure discipline and consistency. Are you getting my point right now? It also provides a record of your trading strategy, so you will find it useful when you are trying to refine it. Are you getting my point? Then number 9, backtest your trading strategy. With your written rules, you can now backtest the strategy. If you have a dictionary trading strategy, backtesting can be an arduous process. You need to replay the market price action and record your trades manually. Are you getting my point? If you have a mechanical trading strategy and the coding background, you can speed up this stage. Nevertheless, looking through the trades one by one is a great way to develop your market instinct. Doing so can also help you think of the way to improve your trading strategy. Are you getting my point right now? So you need to backtest the market right from the beginning or right from so many years, so that it can be able to help you in refining your strategy and your trading plan. Are you getting my point right now? Then let's move to the final step, which is step 10. Plan how to improve your trading strategy. Your first trading strategy will not be profitable, but it is okay. Your trading strategy is a living object. It is not static. Are you getting me? With your growing experience and knowledge, your trading strategy will improve. But let it not leave let's not leave this to chance. Plan how you will obtain feedback and improve your trading strategy. Are you getting my point? Forward test your trading strategy. Plan to take good note of your market observation, record your trade, and keep your chart images in good order. Are you getting my point right now? Also, avoid drastic changes in your trading strategy. Don't jump from one strategy and another. No. Focus on on the one that you've already started. Even if it is not giving you the result yet, keep refining it. Keep building on it until it starts giving you the result you want. So don't jump from one strategy to another trying to find the perfect strategy. No. No strategy in the market is perfect. Are you getting my point right now? Here is for me today. No strategy in the market is perfect. So for this final step, which might take forever, remember that your aim is to achieve positive expectancy with every trade, not positive profit for each trade. Are you getting my point? Let statistics work for you. Are you getting my point right now? Let statistics work for you. So don't force your way on the market. No, don't force your way on the market. So in conclusion, follow the 10 steps above and you will find yourself with a basic trading strategy. Are you getting my point? You find yourself with a basic trading strategy. This strategy is not the holy grail, but is formed through with experience and according to your trading style. Keep working on it and you will stand a chance to succeed in the market. Are you getting my point? So by keep working on it, you get chance to succeed in the market. Are you getting my point? So those strategies, keep working on them. Keep working on the strategy. You get chance you get the chance to succeed on them. Are you getting my point? So don't jump from one strategy to strategy. No. Refine your strategy. Build on them. Keep maintaining them. Keep working on them. Then very soon you will start seeing results because there are no holy grail in the forex market. No. No strategy is perfect. Don't be deceived. Let's talk about the next topic, which is money management. Trading is like any other business. It requires proper money management, which is a very, very important skill to gain its longer term. There is no holy grail, so it isn't wise to try to find the perfect system or indicator that will keep you out of losing, because losing is part of business, like spending a raw material in any other kind of business. Instead, you can focus on one indicator system or at a time that will keep you in the market when the good moves happen. Understand? So when the good moves happen, you can have one indicator that will help you to make profit. With good money management and a good risk to reward ratio, the odds will be in your favor. Are you getting my point right now? So you need to have a good money management in your trading, so that because it is the good money management that will keep you for the test of time in trading. So the main purpose of money management is to avoid the risk of ruin. Neglecting your money management principle as well as emotional trading increases risk and decreases your reward. Practice money management rule on your demo account. Open a trading account and start implementing what you have already learned with low loss size. Here are the top 3 rules of money management. So right now I'm going to be telling you the top 3 rules of money management you need to follow. Number 1, only risk 1% of your account. This is a trade rule which almost every forex trader know about, but they do not follow it strictly. Funny enough, the rule states risk not more than 1% of your equity in a position. That is per trade. Don't risk more than 1% of your account per trade. Are you getting my point right now? For example, if you are trading with a minimum lot size of 0.10 and your risk amount is $100, that means that your stops is placed around 100 pips from your entry. If you scale down to lot size of 0.1 or micro lot, then your stop can be placed up to 1000 pips from your entry. But if you trade one lot, then your stop loss has been put just in 10 pips. Are you getting my point right now? So from the above, we can see how we have arise at different risk level using the same 1% rule. The 1% rule can also be applied to the broader equity, meaning that at any point in time, the opposing position risk is not more than 1% of internal account balance. This will mean that the total net loss of your position, of your open position, regardless of how many open positions you have, is more than $100 based on a $10,000 account balance. Some traders uses 2%, while some traders uses 5% or more, but it entirely depends on how much of the risk you are prepared to take in the market. So in everything, have a proper risk management in your trading career. As a trader, you need to manage your risk very, very well. You need to manage your risk very, very well. Take proper, accurate risk management very, very serious, because risk management will keep you in trading for a very long period of time. Are you getting my point right now? Let's continue. So in the summary, you can see when you have a balance of a $10,000 account and you are risking 1% on a standard lot size, it is a 10 pip per each movement. If it is a micro lot size, you are risking $1 per pip movement, and if it is another micro lot size, you are risking 10 cents per each pip movement. So if you see the diagram, which is the summary of everything I've already said here, it will help you. Are you getting my point right now? So let's continue. We have risk to reward. Risk to reward is the amount of money you may lose in a trade. And remember the 1% rule as stated above. So risk to reward ratio, as you can see in diagram, is the amount you are willing to risk in order to get reward. Are you getting me in this topic right now? Because in Forex, you need to risk something to gain something. So you need to measure your risk to reward ratio very, very well. So when you find a trade setup, the first thing you need to do is to find a place to place your stop loss. Secondly, you need to choose your position size in the way that if the market hits your stop loss, you will lose only 1% of your trading account. For example, when we find a trade in Euro USD that has 10 pips stop loss and the account size is $10,000, the Euro USD hit the stop loss, we should lose $100, which means that 10 pips equals to $100 in a $10,000 account if a 1% rule is strictly followed. I get my point right now. You need to not to be scared about the calculation process, because I have got you covered. There is an automated process of calculating all of these things by using my FX book, which is Forex Calculator Position Sizing. Number one, reward is the profit we stand to make if the trade goes in our favor. The ideal risk to reward is 1:2. Because of every winning trade, you can recover the loss from the previous losing trade and still make a profit as well. Following the example we use above, we have a $10,000 account risking 1%, meaning minus $100. If the next market we have wins, we potentially means twice of what we stand to lose, which is $200. Then we will not only recover what we lose in the previous trade, but also make a profit of $100. Are you getting my point right now? 3. Goal setting. One big reason traders often end up ignoring money management rule is due to emotion, which tend to grow stronger than their risk to equity. Are you getting my point? So oftentimes traders aim for unrealistic goals, doubling invested capital in one or few days. The truth is, why there are some traders who do achieve such goal, it could be that they are more experienced and trading high equity. On the other hand, some amateur get the result based on luck, which I tell money soon gone. So which I personally tell money soon gone, because oftentimes greed of increasing loss size do set in. This will make the account return to normal state or even blow. Funny as it sounds, but it is true. So that is why I always tell you, there is no luck in the market. There is no luck in the market. You need to learn the skill. You can get lucky and win your first trade, but can you be lucky all the time? No. So set a realistic goal based on calculation on the expected return per trade. By having a realistic goal, be it daily, weekly, or even monthly, you'll be able to better equip yourself emotionally by sticking to the rules outlined. And here is how to calculate your expectancy per trade. Expected profit per trade equals to percentage win by average win. Understand? So let's assume percentage win or loss is 55% or 45% respectively, while the risk to reward is 1:2. Using the example of $10,000 account, average loss is 1% by 10,000 is $100. Then by average win 2% by $10,000 is $200. So expected profit per trade, whether if it's 55 or 45%, 55%, $200 minus 45% is giving you $100. That means $110 minus 45, you are still making 65 per trade. $65 per trade. You can also use the format above to determine your expected profit per trade. It is not necessary to get the same result as with the example above, but what is important is to make sure that the market is answer and positive. As far as it is positive, the trading system plus proper money management would make you money in the long run. A profitable trader is not one who doesn't lose trade, rather one who keeps his win above his losses. We will never know which trade will be a winner or which one a loser. Never. So money management should be applied in every single trade, regardless of all or what you think the outcome of the trade will be. I get my point. Even with a system that is right 90% of the time, you could end up broke if you did not apply a sound money management technique. Are you getting my point right now? So then let's talk about trade management. Trade management refers to everything a trader actively does after the trade is executed to maximize potential profits or minimize the risk. Once you are in a trade, the ability to react, manage and control your profit or loss makes you a good trade manager. Selection, timing and management are crucial. Before you get in a trade, you should know what you are trading. Pay attention to each pair, understand its movement, when it moves best and where it gets in. Most pair move during London and New York session and move slowly during Asian session. You should select the timing that best suits your personality, because some like it fast while some like it slow. Are you getting my point now? Whichever trading style you love, just play your card right. Are you getting my point right now? I believe in this phrase is a lot time to trade it smart. Now let me tell you what this means to me. It means locking in profit once your position is floating in blue, because we cannot tell what may happen the next minute. So it is wise to lock in a little of your profit rather in loss rather than a loss a chunk of trading account. When applying this rule, you should be careful not to play the stop loss too close to your current market price in order not to get stopped out prematurely. You could use a percentage of your trailing stop on your phone or desktop. Move your stop loss once a major support or resistance is broken. So another tip is this: not to get stopped out prematurely, and is using as a regulated broker. There are many things we consider before selecting a good broker, which I have already analyzed in the previous video that I teach you in part 1. That is why I tell you that you should go and watch that part 1. Are you getting my point right now? That is why I recommend that is why I recommend the one I use personally. Are you getting my point now? The fact is this: if you don't have a system that is right 100% of the time, you should use money management and also understand trade management, meaning you should use it, because such a system does not exist. Regardless of how big or how small your trading account is, we will never know the outcome of the next trade, and this one trade could be the last of the one you don't apply money management. Using money management is an option. It is a must if you want to achieve your trading goals. You need to do whatever you need to do to be able to trade the next day the next week or next year. If you want to be successful in this business, my brother, for the long time, apply proper trading sizing techniques. Are you getting my point right now? So if you want to be successful in this business, apply proper trading techniques for a very long time. So this is what I want to tell you. In all this thing, my brother, listen, make sure you practice proper money management in your trading. It is very, very important. Make sure you practice a proper money management trading in your trading. Manage your trading very, very well. Apply proper risk management. Avoid greedy. Avoid being greedy. And have this mentality that anything good takes time, because Rome was not built in a day. So don't fall a victim of get rich quick scheme. No, it doesn't work in trading, and no strategy is holy grail. So there is no holy, there are no holy grail in forex trading. No strategy is perfect. Some way, somehow, you have to lose money in trading, but the goal is this: that the money you are making in trading is more than the profit, is more than the money that you are losing in trading. That is the goal. That is where proper risk management comes in, and that is where your trading plan comes in. So that is my advice for you. Please do not give up. Do not give up on your trading journey. If you're a beginner, keep learning, and keep gaining more knowledge. If you have watched this video up to this moment, please make sure to like this video, make sure to subscribe to my YouTube channel, and also make sure to comment down below if you have any single question concerning any of my video. Also check out other of my video on my YouTube channel if you want to know more of trading, of anything concerning trading and the financial market in general. And I will see you on my next video episode. Thank you for sticking with me up to this moment. Thank you. Take care. Stay safe. And bye for now. I will see you on my next video episode. Bye.